It's happening. The US is ordering banks to back away from China. This isn't just a trade war anymore. This is a full-blown financial decoupling. From Wall Street to Beijing, from IPOs to gold, the global money game is being rewritten once again. The trade war with China is in a dangerous limbo. No one's picking up the phone, and the diplomatic channels are all but frozen. The US government is scrambling to wrap up deals at breakneck speed, 90 deals in 90 days. And we know what happens when you rush things. Botched agreements, unclear terms, and loopholes that you can drive a truck through. This means even more uncertainty is guaranteed in the future. Meanwhile, US politicians and government are looking at reviving industries like fishing. Yes, you heard that right, fishing, with big promises of economic revival in that industry. While that's been happening, the Chinese have been doing the real work of trying to shore up their alliances and shore up their Asian networks and building an economic fortress. Forget tariffs for the moment, but the real battlefield is shifting to the financial system. In a massive escalation, a congressional committee has told JP Morgan Chase and the Bank of America to drop their investment in Chinese EV battery makers IPO. And get this, the IPO isn't even happening in the US, it's in Hong Kong. Yet the US claims the move could expose American investors to reputational and regulatory risks because the company, which specializes in lithium batteries, is allegedly linked to the Chinese military. Now, regardless of how real you think that connection is, this marks a new chapter. Washington is actively trying to cut off capital to China and especially to their tech and defense adjacent industries. This is where things get really serious, as US banks operate all over China and Hong Kong, providing asset management, investment banking, and trade finance. If Congress keeps tightening the leash, then American banks could lose access to one of the biggest financial markets in the world. This is not just about CALB's massive $5 billion IPO. It's about hundreds of billions of dollars of future business at risk. Sure, JP Morgan Chase and Bank of America are big names, but there's also a lot of other banks like Standard Chartered and HSBC who can jump into the mix and sort the IPO out. IPOs aren't rocket science after all, and if American banks jump out of the race, international banks can easily fill that void. Now let's talk about China's counterpunch. China knows that decoupling can easily cause financial distress and panic. So to keep investor confidence, what are they doing? Well, they're taking aggressive steps to shore up their stock market. In the past few weeks, China's sovereign wealth fund and state-owned institutions were seen buying up local equities. The goal: stop the bleeding, restore confidence, and send a clear message: we got this. In most countries, heavy state intervention would raise eyebrows, but in China, it's the norm. They're using their massive trade surplus and low interest rates as firepower. While US bonds are rising, Chinese yields remain low, making it easier for the government to inject cash without overheating the economy. This creates a floor for the Chinese stocks. So if all the American money pulls out, this makes China the buyer of last resort. Essentially, the Chinese government is hedging all of the investors' bets for them. If this continues, we're heading for what Goldman Sachs calls extreme financial decoupling. US investors have poured more than $800 billion in Chinese companies through listings in New York and Hong Kong. If forced to pull out, this won't just hurt the Chinese economy, it will also cause another Wall Street sell-off and cause a butterfly effect with a sell-off around the world and making the economic situation in the US even more difficult. So no more Alibaba or JD.com investment in New York for the cronies of Trump and his billionaire ilk. Investors will need to open Hong Kong accounts and switch to using Hong Kong dollars, ditching the US dollar in the process. That's a direct hit to US financial influence. But wait, it cuts both ways. Chinese investors also hold 1.7 trillion in US assets, including 370 billion in US stocks and over 1.3 trillion in bonds. If Beijing retaliates and dumps US assets, bond yields could spike and stock prices could fall, and this would create even more enormous pressure on the US dollar. And it's already happening. The Bank of America has already reported 6 billion in capital outflows from US equities. That's the second largest exit on record ever since the collapse of the Silicon Valley Bank in 2023. Foreign investors who hold 20% in US equities and 30% in US bonds are losing confidence fast, as US assets are no longer seen as risk-free. Even Chinese investors are redirecting capital to European bonds, gold, and Japanese government debt. That's a massive shift in sentiment, one that could reshape how the whole economic system works. Gold is the big winner here. Chinese investors have poured nearly 800 million into Shanghai gold ETFs in the last month. Western funds like GLD are soaring. Demand for physical gold is also soaring. This is only going to grow as tensions rise, and the loser here is the US economy, the US stock market, and US banks. When trust in governments and markets collapse, people start to look for real investments, and gold at this moment is king. It seems even if the US called off the trade war tomorrow, it won't stop here. The decoupling's not going to stop. It might slow down, but the foundation of global finance is already shifting. So what happens if the US forces a full delisting of Chinese companies? Will China dump its US assets in retaliation? Let me know in the comments. And if you found what I've shared informative and helpful, please do hit the like button and subscribe